Welcome to another Wealthy Boomer interview. Today our guest is Danielle Park, author of Juggling Dynamite and also an investment counselor with Barrie-based Venable Park Investment Consulting. Thank you for coming in despite this terrible weather. You're a bear, and your book is pretty bearish, and you have a pretty controversial title, Juggling Dynamite. But so far, you've basically been right. You were telling me earlier that a client was really upset when they read the book. Well, you tell me the story.
Oh, no, that's not a client. First of all, I'd like to say, just for the record, I don't agree that I'm a bear. Okay, I say that I'm a realist, and I've maintained that throughout. It's not my fault that there are these ridiculous cycles playing out in the world right now, and that risk was really underpriced. And so I don't accept that I'm always bearish or anything of that nature. It's just in the last couple of years, some of these risks have become quite important to take note of, in my view.
Now, aren't they priced into the market now? We've had the big correction in January, and we have little mini corrections even into February and presumably in March. But this whole thing about stock prices foreseeing the future, that the economy is already in recession, it already factored that in, even if it started in November? Or are you saying there's still worse to come?
I'm saying that if this is a bear market, then that's been very, very faint. We have one of the main metrics that we use in trying to gauge this, because forecasting is very difficult. We try and avoid that at all costs. But what we do know is what the market has done and what is happening on a day-to-day basis. And so from our perspective, some of the most significant things are the technical breaches that have happened in the long-term trend that was in play from the recovery coming out of '02. So '02 to '07, we had this big bull run up in equity prices. And we've now come off those highs and breached in very significant ways in most indices all around the world. So that, plus coupled with the fact that where intermarket studies indicate that technology and semiconductors, for example, tend to lead the overall market down, as do financial shares. And both of them are now, for example, semiconductors is below its '02 low. So that would suggest that there is still quite a bit of correction coming.
How far do you see it going down?
Well, again, I try and avoid forecasting as much as possible because, there's a bunch of different theories. And if I started to talk about the worst case scenario, then someone would say that's ultra bearish. We do know that when we're in secular bear cycles, which I believe we started into in 2000, I go into that in the book. And when we are in secular bear cycles, it is not that you cannot make money in stocks or equity investments, but you need a much more tactical approach in order to do that. Why is that? Because a secular bear is not this sort of smooth upward trajectory like the 80s and 90s in a secular bull. A secular bear usually has two forms. One, it's a trade-bound market, which is in a trading range, of some up, but then a corrective phase, some up, but a corrective phase. If you do anything buy and hold over that long period of time, you tend to get nowhere because it is not just a smooth ride up. The other thing, and this would be the worst case scenario, some secular bears, like the 66 to 82 period, were a series of lower lows. So on that sort of a metric, that would suggest that the semiconductors, for example, that are already breached through their '02 lows are signaling the potential for the market, the overall market, to retest its '02 lows. Now, that would be something in the area of 5,800 for the TSX. Again, I'm not forecasting that, but I'm a realist, and I'm aware that when we are in these secular bear cycles, these type of dramatic outcomes are not unusual.
Okay, now in my advisor post column recently, I surveyed a bunch of advisors after the late January kind of big correction, the one where it was in all the headlines. And every one of them said they were buying that week, either for their own accounts or for their clients. Are they making a mistake? Are they deluded?
They always say that, Jonathan. That's what you have to understand. 95% of the people that are giving investment advice out there don't have any actual rules about when they buy and when they sell. They buy whenever you bring them money, and they never say that it's time to leave equities. So once you accept the world as it is, that is the case.
It's an equity culture.
It's an equity culture. It's a long always culture. It's just a plop it in whenever you happen to get the money. So once you realize that, the more important question to ask people is, okay, I hear you say that you're buying. Tell me, please, when do you sell? That is really the question that you need to ask. And I would suggest to you that most people will say, well, I don't really, we believe that over the long, and they start going into this whole sideways, explanation for why they have no sell discipline. That is the state of the world we live in.
I think I talked to one of the indexing kind of, Larry Swedrow, that kind of person in the States, and they're basically this whole let's buy and hold for the long run. And the only time to sell is if you need the money or if you believe that capitalism is no longer going to work. How would you respond to that?
Just what I just said. They don't have any actual discipline to manage money. Most of the people are, and I'm sorry to say this because I understand it upsets some people, but I'm afraid the truth of the matter is that most people giving advice in the financial world have no actual skill at money management. What they are salespeople that are there to direct people into different equity products. Now, some other types of products as well, but it turns out that the margins and the fees are the highest on the equity products. So they sell people hope. And they say, all you need to do is just give me this money and I'll spread it around here and it'll all work out. And what I'm saying is that that may be reasonable as an approach during a secular bull cycle like we had in the 80s and 90s, because you had generally straight up markets. Although if you remember some of the contractions in there, 98 and 99, 2000, they were pretty extreme. But during that period, you could generally put money in at some point and it would generally go up over 5 and 10 year cycles. So what happened was the people in the industry really adopted that as the rule of thumb, that that's what always happens. But in fact, that is not what always happens. And if you do any critical thought on this at all, do any real work on history and cycles and looking back, you'll see that that is actually a very anomalous period. And that tends to have, throughout history, whenever we've had one of those periods, it has always been preceded by a much different period and followed by a much different period. And those would be climates like we're in right now.
Now, some people would say that you're talking about market timing, and then the buy and hold crowd will say about market timing that it requires being right twice, once when you get out, once you get back in, and that the danger of getting out and being in cash or bonds right now is that you're going to subject your returns to like a 4% annual return. And if the market suddenly skitters up on the upside just as much as coming on the downside, then there you are, you're really out of luck. You sold high and you can't get back in. How do you respond to that?
Because again, if you don't have any discipline, then I agree with that 100%. If you're just going on, well, I think today will sell because I feel bad or people are negative or the market's crashing, if that's your approach, then I would suggest that that's disastrous because you don't actually have a discipline. So having a real discipline means that you have some objective rules, whether they be fundamentally based, whether they be technically based, valuations, whatever they are. Lots of successful money managers in the world have their own set of rules, but they can articulate them to you. And they don't buy whenever you happen to give them money. They buy when they get buys on their rules. And so if you're dealing with someone that has that kind of a discipline, then okay, that's a market timing approach. If everyone wants to say that's a market timing approach, that's fine. Having a discipline is the only way that you can control your emotional responses and give you the highest probability of making some success of your investing. If you're doing it on this gut wrench, well, I'm going to put it in today and take it out. Oh, it's gone down 10%, so I think that's enough. That's the kind of knee-jerk reaction that is not actually a strategy at all. And yet that's what most people will say, well, you see, you can't time markets because, I felt bad last week and I took it out and the market raced on without me. That isn't a market timing tool. That's just an emotional response kind of thing.
Okay, I think we're out of time on this one. People can get more information, order the book, get your daily blog or almost daily blog at jugglingdynamite.com.
That's right.
And next segment, we're going to talk about your criticisms of the Canadian financial industry.